Good morning, everyone, and welcome to Stellenbosch, the Woordfees, and we're very happy to have you here. Today, we have a discussion on seeding prosperity, looking at the next wave of agri-finance. And our discussion really today really wants you to participate. So if you have any questions on whatever we'll discuss, we'll give some time for that. But really, we're excited to be here today, and I'll just give a quick introduction of the topic. Then I'll let my panel loose to cover quite a wide range of topics. And then, you'll have some opportunity for questions. So my name is Lopinar. I'm from the Bureau of Food and Agriculture Policy, so that's shorthand BFAP. And what we all about is we want to see the agriculture sector thrive, and we do analytics and research to really enable that. And the reason why I'm here today and facilitating this discussion is because finance is such a crucial component of enabling, a thriving ag sector. I mean, just think of if we didn't have, businesses willing to lend money or insurance products to agriculture, where we would have been today. So very excited, but of course, many challenges. We know agriculture is quite exposed to risk. So that's one of the reasons why we've got insurance products. When you do you apply for finance, there's quite a process to get into the decision to hand out money for you to invest in your farm or your business. So let me introduce the panel briefly, and then I'll just start with a generic question, and then we'll go from there. So I'm going to start on my right. We've got Zaan Meyer. So he's from Nedbank. He heads up the CIB business for agricultural commodities. And he has mandate to promote and expand the group's soft commodity trade finance strategy on the African continent. And he's been in agricultural finance for a very long time. Is it 2 decades or 3 decades?
It's 2.5, if I may.
2.5 decades. So welcome and thanks for joining us, Zaan.
Thanks, Lo.
And then we've got the man from the Land Bank. So I'm sure he brought his checkbook with him if you need some finance. But we've got Saki Short May for he's from the Land Bank. He heads up the division within the agriculture economics division within the bank. Of course, there's a number of agriculture economists there. He's been in the private sector before he was with the Land Bank. And we're very happy to have you here. So, well, thanks for joining us.
Thank you. Thank you, Lo.
Great. Then, last but not least, we've got Andries. So Andries Visser, he's the National Business Manager for Hollard Insure, and he was also previously the head of agriculture. He's been there for many years, and he understands agricultural markets and risk very well. And we're also very happy to have you here, Andries. Thanks for joining.
Thank you, Lo.
Great. So let's jump into this. We don't want to just cover in this discussion just the traditional discussion on finance. We want to look to the future. So I'm going to ask a generic question to the group. How do you guys see finance, agri-finance, in the next 10 years evolve over time? And what are the main sort of topics to look out for that we can expect in this sort of domain? Let's start with you and go to the right.
Yeah, thanks, Lo. I want to talk not about the next 10 years, but the process has already started. And I think conventional commercial banks, and now I'm talking South Africa as well as the African model, has already started to change. I think the model of looking at a balance sheet, 60-70% loan to value, registering a mortgage bond, and here's your production loan for the next season is going to become antiquated very, very soon. There's a couple of reasons for this. The one is that we are seeing that commercial farmers are using more and more leased land to actually get synergies and benefits of scale. You can't give leased land as collateral to a bank, so you need to think about it a bit differently. And the other very true and very close to my heart aspect, the reason for this is the fact that our emerging farmers don't own land generally. So if one starts operating in Africa, your model is totally different than what you do in Africa on a conventional mortgage loan basis. So I think what we're seeing and what we already started doing in terms of transforming our finance model is to look at an income statement model rather than a balance sheet model. Now, there's a hitch of the kopskuif in that. You need to think a bit differently about it because now you don't have collateral. There's no tangible security. You need to think about the jockey and his ability to produce crop to repay your loan. And I think that's where things like insurance comes in, a very important aspect for us in structuring these type of solutions. And maybe just another thing that we are seeing and really paying attention to is I think climate change, and we know it's real. I was close to Worcester yesterday, and the snow on the mountains absolutely beautiful. But what does it mean for a apple and a pear farmer who needs pollination at the moment? A bee doesn't operate here. Climate change is real. We see it every day, and I saw it yesterday, and I see it in Africa in terms of the impacts of El Nino and La Nina, especially in Kenya and Tanzania. It's devastating what that does to farmers who don't necessarily have the infrastructure and capex to protect themselves against these risks. So I think what's going to become important is facilitation of climate change related finance and capex to especially our small scale farmers.
Thank you, Lo. I think from our side, we've looked at the sector itself. We see that there's quite a number of challenges that are there. As Zan has mentioned, climate change is one of them. And I think sustainable farming is the buzzword. And if farmers don't adapt, I think we will find a challenge in terms of food security going forward. So we bracing ourselves for these challenges. As a lender, we look at the developing farmers. That's our mandate. We are providing finance to both commercial and new era farmers. However, what is key for us is to look at how do we then bring innovation within our space. As you know, smallholder farmers, it's difficult to finance. There's barriers to entry. And I think, to Zan's point, the issue of cash flow lending is more predominant on that side. So what we look at into the future is that, which we have started already, is the aggregation model, which we've put together, whereby the smallholder farmers, they would aggregate their produce so that you are able then to get offtakes for that, and which is something that is going to grow for us to support smallholder farmers. And we're also venturing, looking at the commercialization of some of the smallholder farmers where they are moving into acquiring farms. We're using blended finance as an instrument. As part of enabling them, we look at technology, which enables them, because what we have found is that one would want to buy a piece of land, not knowing what is the natural capital. And then what we have deployed within our space is GIS technology, which then informs what are the risks of that piece of land, what is suitable for that type of land. And what we are overlaying now is the monitoring thereof in terms of the crop. So technology is going to be key going forward. So we'll be building data in terms of understanding each client. But I think for farmers, it is quite critical that the small farmers adopt the technology. And technology is quite expensive. And we will be in the journey with them to try and see how we support them. So there's growth in terms of agri-tech and innovation, sustainability. So those are the potential opportunities that are there. And even with the risks that are there, they are creating opportunities for the insurance. We've got an insurance leg of the business where products need to be developed to actually mitigate the risks that are there. I mean, we've seen the loss ratios recently going up. So we need to prepare ourselves going forward in terms of how do we then enable farmers to be better prepared, because I think adaptation is quite key going forward, rather than being reactive and bringing mitigations after the event, which normally impacts the profitability and sustainability of the businesses. I'll pause there.
Great. Andries, from a risk perspective, insurance, give us your take.
Lo, these bankers are very clever. And they haven't talked utter rubbish, but they've spoken, I think, critical points from a financing point of view. But there are two issues that actually segue out of that and have to link into that. And the one is that it's a bit like you got to wear a jersey because your mother's cold. That's the one part of it. And we experience that. The dependency of the South African market on what's happening in the rest of the world has never been as profound as it is now. So I'm an old man, but that's not the point. The point is, in all my years, for the first time over the last year, 2 years, in South Africa, we've had this fascination with the repo rate of the American Federal Reserve. Why? But it has an impact, and it talks to what we're doing here, and it creates expectations and things. And that's one example of it. In the insurance industry, South African insurance industry is heavily reinsured to the European market. So what essentially just happens is that we take on a risk, and if we think it's too big or too bad or to whatever, we have a formal agreement with European reinsurers, and they take a part of the risk for which we pay them. You don't see it as a client or as a business, but that's what happens in the background. The challenge is that whatever happens in Europe dictates the appetite of those reinsurers. So if Europe has a calamity, or the Americas, in some way or form, it's going to hit us here. So that interdependency, that sort of Mother Europe, Mother America, we haven't gotten away from that, and we are still exposed to it. In practical terms, in the rand sense, what it's going to cost you to buy insurance or lending or whatever. The other part is that, and both Saki and Zahn alluded to this, the change has already started, to Zahn's point, and it's been so big, I don't think we've kept up as an industry, and I'm not talking on the banking side, I'm talking from the insurance point of view. And our clients have not kept up. So we're still stuck in models that used to be good enough and that used to serve the purpose and do what it was supposed to do. But the world has changed, and you might very well at this point in time be trying to solve a very real, modern, complicated technology, et cetera, problem with an antiquated model. And that is the challenge, to bring all of that together.
Now, I'll maybe just sort of expound on that, because in a sense, I mean, to everyone here, agriculture is exposed to risk because if it rains or hails or it's very cold, we're very exposed to the outside. You can't just take your crop and put it in, I don't know, into a garage like you would your car and protect. So basically, you exposed weather-wise, market-wise. South Africa is a very small economy, but open to the rest of the world. So whatever happens elsewhere, that influences our market. But I want to touch base on this sort of old models and whether they keep up, because I'm trying to think that you're sitting with a situation where agriculture has always been exposed to risk, right? It's not something new. It's been like that in the 1920s, 1950s, and we've got new models and ways to insure. But let's say climate change is causing risk to increase, right? So the frequency, severity of these events are increasing. It's a fact. But then we kind of know what to expect also because of hindsight. So is there a way where these models and new technologies mitigates or offsets the risk profile so that in a sense you've got a better spread, of, let's say, products that people can choose to buy at a fairly lower price? Because I think the challenge with everyone, well, for everyone here, is that over the long term, agricultural commodity prices tends downward. So that means if you want to stay in the game as a farmer, then you need to either, grow more per output. So that means higher yields or better quality. And because you're on the pricing side, you're not going to get over the long-term support in that, or you need to better manage your costs. So that's where we talk about the cost price squeeze. But then as we go along with all these technologies, shouldn't risk and, let's say, financial products become also cheaper to some extent? How do you offset and think about that for the future?
Now, for an economist, you weren't thinking now. I mean, the bare fact that the risk has increased, because pricing is purely a function of risk. And you can categorize risk in various ways, and the banks do the same. There are various factors that come into play, and that's how you decide on it. If we talk about risk and changing, and a good example of this is in its most basic form, a farmer who's growing crops, let's say maize, would take out what is known as a hail policy. That's sort of a generic term throughout the country, and it's a very basic, bare bones, hail type policy. It covers a few other things, but essentially the key part is hail
That
and
would
fire.
be the minimum requirement for a production, though. You start there.
Zahn wouldn't look at you, and Saki wouldn't either without that. Now, the challenge with that, it's very labor intensive. It's a very expensive product for an insurer because of the logistics involved. And it's each individual farmer. It's got to look at all sorts of things. And the pricing of it is determined by the greater behavior of the weather patterns and the farming communities. And again, the Europeans come into play as well, and the Americas. That product has, in the last 30 years, not changed. It's exactly the same thing. But a commercial grain farmer from 30 years ago and a commercial grain farmer today is in a different world. They're not even on the same planet. So those changes have changed. And we must also remember that we tend to think about the crops. We tend to think about animal husbandry and livestock and horticulture. But there's another part of it as well. 30 years ago, 20 years ago, 10 years ago, farms were owned by individuals, family farms, and it was Andries Visser trading as. What has happened is that the business forms that farmers farm in has also changed. And that in and of itself has brought other challenges. As a banker, I would imagine you're no longer talking to Low, you're talking to PTY Limited, or whatever the case might be. And from an insurance point as well, and your exposures change. Suddenly you've got a board of directors. What about them?
Yeah. Now, let me just ask you again. So let's say, for instance, we've got over 100 years of climate data, right? And we can, in a sense, project, let's say, El Nino impacts, right? Whether that's every 10 years, 12 years. But we've got the tools and the regional data points now to at least do a better calculation on risk. I'm assuming we're getting better on risk calculation. That's what all the clever guys with actual sciences and the like. So my question is, if we know a lot more in this data-driven world, is there a space then where, let's say, you get more people on that and it becomes cheaper over time? And I think it will, and I'll give you a chance, but I'll also go back to the banks. Because when I look at it from an ag economist, I'm saying if I want to start farming now, and then I'll go to the bank and I'll need some insurance as well, how do you buy a farm now? And typically if you buy that farm, you'll have to reinvest in probably something new, because that farm would be in the market because maybe it's not doing well. How do you take out a loan now for 15 or 20 million, and farm that out? And that's the question we have if we want new. I'm not even talking about emerging farmers. I'm talking someone with the skill set to farm very profitably. But at those levels of, let's say, the current rates and the cost of these things, is it still sustainable for growth in agriculture? So that's a bit more my thinking around that.
I think the numbers probably speak to it. Yes, we've got a much greater ability to forecast. The challenge for insurers is that we look at frequency, in other words, how many of these things happen, but we also look at severity. So when it happens, how bad is it? Now, locally, if we just talk flooding, and you sort of scan your own memory over the last 2 years, you've seen floods. In the USA last year, $151 billion US dollars, weather-related claims, insured weather-related claims, all right? 15 individual events were more than 1 billion rand in and of themselves. So that's the type of thing. Now, if that doesn't scare you, I don't know what will, but it scares me, certainly. So the predictability becomes greater, but the severity increases. And hence it negates the value of knowing it's going to happen. And it's going to happen more, and it becomes unpredictable in terms of exactly when or where. We know it's coming, we just don't know when. So,
Okay, let's throw it to the banks. Maybe you first, and then Saki.
Yeah, I think Lo, what has happened in terms of the banks and the pricing models is it is purely Basel driven. The banks have got the Reserve Bank, obviously regulations in terms of capital that we need to reserve against risk. If you bring a balance sheet into the equation and you do your sums in terms of the ratings, and you fall back on the traditional model of what's the value of the land, one should theoretically be able to say that agricultural land in the last 14 years have grown on average by 18%. That's capital appreciation. It tells you in terms of an average that it should actually physically become cheaper. But now you put the balance sheet effect into it. You talk about our citrus exporters and the problems they had with logistics and container costs and all these kind of things. That bears directly down to the bottom line, and it actually also impacts on the risk model. So you're 100% right. We price for risk. And that's why I think in general, the pricing on agricultural portfolios across the commercial banks and including the land bank has generally gone up over the past 3-4 years. Unfortunately, COVID had a great role to play in that. Talking about the insurance industry and how we use those tools, and it's not only us. If one looks at the severity, and Andries referred to it now, Just go north of our borders in terms of Zambia, that lost half their maize crop last year. Zimbabwe lost 60% of their maize crop. Zambia is importing maize for the first time in 22 years. I think it's critical that we understand that there are tools available, very limited at this point in time, but there are very clever people sitting in Kenya, for instance, and I'm going to name the name. It's called Pula Insurance. These guys, I think the last numbers, they insured 10.2 million small-scale farmers in an area of 20 million hectares. Now, 2 hectares per farmer, it shows you the scale, right? But it is a combination of weather index-based and yield index-based insurance. And the claims ratios, it's not healthy, but it's sustainable. I think in the last 4 years, they've paid out $121 million. Governments like the Zambian government are actually taking out those insurances. Why are they doing it? They're wanting to keep the farmers on the land. So the moment there's a calamity, that policy responds automatically. It is not about every single farmer being registered as an insured. It's an index-based global policy, and Pula is very clever in terms of how they monitor that, and satellite technology, people on the ground. The policy responds, government gets paid, and they distribute those funds to the farmer, so at least they can stay on the farm and buy food. That's the kind of model that I think banks should be adopting. So we are talking to companies like that to see how we integrate those policies into our risk models to make sure that we can actually fund these small-scale farmers. Now, we can get to it a bit later in terms of skills transfer, mechanization, creating markets, input availability at the right time in the right place. But I think we must start there because technology, John, in terms of remote sensing, probes in the soil, satellite imagery, it does allow us now to manage risk in a different way, more frequently.
Maybe I'll just sort of explain. So index-based basically says because traditional ways of doing finance and risk analysis means Saki or the bank needs to have someone or the insurer go to the farm. Typically when you do a claim on your house was flooded or something, then someone needs to come out, drive to you, spend time doing a claim. There's multiple people involved in the institution and it costs a lot of money. So imagine you multiply that by 2 million people that you need to visit, then that exercise of itself is just inefficient and not viable. So what he's explaining, Zahn, is that index-based system is that you don't require as much administration, is you locate the farmer and then the weather patterns and how that farmer, if he's in a particular area, you can already pick up with the weather data and if it received rain or not. So let's say you're a maize farmer. Typically, you see in a typical month where you need rain, let's say December or January, you didn't get rain because you can pick it up on the satellite imagery, then automatically it will trigger the payout of the insurer. So it means just a lot less activities that you require people to do. And I think that's the basics of that model, which you explained, index-based insurance. But Saki, I want you to also elaborate on that.
Yeah, just on the side of Land Bank, I think what is key for us is that, as you would know, the Land Bank gets its funding from the open market, and as such, it's risk-based financing. So inherently, we then have to pass it on to our borrowers. But what compounds the issue is that, in a similar boat as the commercial banks, we've got IFRS 9, which is a reporting standard. And it sort of dictates how we should manage our portfolios. And as such, you find that agriculture is much riskier and you have to put in certain overlays. So there's modeling that is taking place that drives the provisions of the bank. And as such, that then translates to the pricing effect, whereby we look at the probabilities of default as the other banks would do. So you find that the models that we're using from a pricing perspective are actually similar, and we are a DFI. So you find the expectation is that as a DFI, our pricing should be lower. And this is the challenge that we're sitting with. So what we are busy doing to try and resolve this problem is to look at our funding model. Our funding model needs to change, and we have approached the shareholder to say, in terms of going forward, we need to find a solution. We're putting proposals to them because going to the market doesn't assist. And also, we're also looking at multinational funding grants in terms of how we can get impact funding. However, as you would know, the bank recently came out of default. And we are looking at different ways of how best we can then structure our balance sheet to optimize it for the benefit of our customers. Because at this stance, our pricing is quite high, not very much competitive. And by finding solutions to the funding model, I think it will go a long way. With the capital injection, for instance, that we have received, it will sort of bring also a relief in terms of blending that finance with what we have in our reserves as part of what we can then give to the farmers. So invariably, we need to make sure that going forward, the risk mitigation, you spoke to data that is available. Data is going to be the dictator of how we do business going forward. And the models, in order for one to have a reliable model, as we know, is based on data. So you find that in our space that we're operating in, where there's new entrants, there's limited data. So it is quite important for us to build data as we growing our business. As you would know, we're doing blended finance. We've issued over R1 billion in terms of that program. So whilst we're running that portfolio, we're building data on it, which will inform then decisions going forward. We need to understand what the farmers are going through. And what we're doing is also partnerships. These partnerships, obviously, we've come to a realization that us as the bank alone, we won't be able to win this. Collaboration is quite important. We've created a partnership and ecosystem environment within the bank where we partner with commodity organizations. We engage even with banks where we've got common interests to try and see how we can salvage the situation, because the challenges that are there are quite enormous. So it is quite important for us to build the data so that ultimately we can then bring down the costs of the farmer, but at the same time also making it sure that the farming becomes easier, because these days with smart agriculture, it will also assist us in terms of monitoring the production practices, whether they are doing the right thing at the right time, much as they can do it also from a palm of their cell phone, in terms of when to irrigate, which portions of the farm. So all those benefits, I think, going forward, should bring benefits going forward in terms of pricing. Thank you.
Saki has mentioned blended finance. I'm just wondering if we should maybe elaborate on that. Everyone, the audience, familiar with the term blended finance or not? Should we? So basically, I'll just, in short, so it's just a new proposal now where banks with the land bank and commercial banks with government comes together and provide for emerging farmers a blended finance rate. So part of, let's say, government trying to support smaller farmers, in the past it would give the farmer a grant, let's say seeds or access to land on the land reform program, and that farmer would then go to the bank and try and get funding, sort of like a normal way that anyone would do it. But now they say, let's work together. Government puts in a certain proportion of funding or spending on that farm, right? And then they put it into a blended model where they work together so that the money that, or let's say the capital that government wants to spend on that farmer can now take to the bank and get a much better rate, because it reduces the risk for the bank, right? And he can get a fairly better interest rate, but still then a portion of that is a grant. And so the idea behind that is really to offset the risk. I think the bank is reluctant because obviously many of these farms, they don't have collateral and the like. So it's in a sense the new innovation that's been driving, and I think it's just been launched, or is already any farms on that program, or is it just getting started?
There are farmers.
Okay, so we already started
yes.
to go there.
And then I think there's a strong collaboration effort, and obviously the much needed collaboration in terms of, we know we need to work with the land bank. The land bank is the custodian of that funding from government. And what that does for us as commercial banks, as you rightly said, it mitigates our risk. We almost got a mezzanine or a first layer before we get to the senior debt that obviously the commercial banks advances. So I think from that perspective, Saki spoke about partnerships. Companies like PALS, the Partnership for Agricultural Land Solutions, what they give and what they bring to the party in terms of corporate governance, structuring, shareholding, shareholders agreements, loan agreements, business planning, facilitation of budgeting. Those type of things are all important for us because that goes back to what I previously said about the income statement approach, right? You need to understand and build in financial literacy into the farmer's mindset, that he always realizes that there's debt to be repaid, and the only way you can do that is by increasing yield and responsible farming, sustainable farming as well, which is also important. So if a loan advancement then includes a component of switching from micro to drip irrigation or variable drive irrigation pivot systems or low emission tractors or whatever the case might be, then there's a real need for banks to look at that as well, because that's the only way we're going to keep those farmers on the land, apart from the fact that they need to know what they're doing, of course. And the worst thing we can do is give a piece of land to a farmer and say, here you go, good luck. And unfortunately, that has happened before, and we know what the end of that is. It's always sad.
Andries, I want to get back to you, or you wanted to respond, and then I'll ask you.
I actually just wanted to, in terms of partnerships, I think we also need to credit the government at this point in time for the efforts they've been making. We talk about index insurance and we talk about mitigating the risk on a larger scale for many more constituents. In her first term as Minister of Agriculture, Toko Didiza initiated that plan. It took the insurance industry, and we're not very proud of it, very long to get to some sort of an answer, which we have. There are other issues as well. Index insurance as a concept was illegal in South Africa until a year ago. We had to go through a whole sandbox exercise, prove the validity, etc., etc. But it's now starting to come into play. I just want to warn that we also need to understand that no single solution is going to answer all the questions. And in as much as an index type policy, which is currently best practice worldwide, probably the best solution, it has shortcomings. And the nicest illustration for me is about 12 years ago in Botswana. The government took out an index program for all its farmers. Now, understanding as well that on the eastern side of the country is largely irrigation and on the western side is livestock. We've got similar type of world that we farm in, livestock as well as planted crops. What happened that year is there was a terrifying drought over 2 or 3 years in the Khansi, in the western part of Botswana, whereas the eastern part, because of climate change and a few other things, had record rainfall. What happened is the grain farmers had bumper crops. Some of them actually double cropped in that season. But because of the severity of the drought in Khansi, it triggered the drought. Trigger was hit, which then meant that the farmers who had double crops, and those were bumper crops, got a payout from the insurance part because the index triggered. And the poor farmers in Khansi also got an index payout, but it was a relatively small one because the bumper crops mitigated the issue. So we've got to be careful, and we need to understand the vehicle isn't always as perfect as we think, but it certainly is a way forward. And the current Minister of Agriculture has taken up that baton. And so he's working closely with the industry, with the banking and the financing, etc., to further that program. So we're looking at really finding solutions that will work for both upcoming new entrants, but also large commercial farmers as a base layer onto which we can then do conventional things depending on the specific needs.
Yeah, no, that's actually the question I want to ask. You've been in this insurance business for a long time and through this different phases in South Africa's, let's say, history. And of course, we've got new government coming in. Everyone's excited. There's better sentiments. Everyone's saying it's going to be better. Economic growth, interest rates are coming down. What would you say, let's say, of all your experience to, the risk currently in agriculture, specifically, let's say, for farmers? What is the sentiment and the way you are profiling risk, let's say, to 10 years ago versus 20 years ago? I know it's vague, so you can answer it vaguely. But do you also experience that from a risk perspective, things are looking better in the immediate term relative to the past? Or is it still very high risk levels and you're pricing in accordingly?
The answer lies on 3 levels, essentially. And the first one is that base climate, weather-related losses, it's as high as it's ever been. That's as simple as it is. Second to that, the other part is that all are not created equal, and I alluded to it just now as well. We tend to focus a lot on plants, horticulture, and grains. We forget that South Africa is a very high livestock farming entity as well. And those solutions don't look the same. You know, in Afrikaans we sê elke man soen sy vrou op sy eie manier. En 'n beesboer en 'n graanboer is twee verskillende diere. So we need to understand that, and the risk differs as well. Pure agricultural risk is better than it ever was, and it's built up over a period of time. It's not the current government. It's come over a piece of time. If we look at the NDP, agriculture, a key part of it. The importance of agriculture from a job creation point of view, from a food security point of view, and an economic point of view. So to answer your question, generally, I think agriculture is in as good a position as it's ever been, but it should be petrified of weather.
So you're not going to buy a farm and start farming soon? Or do you already have a farm and farming?
Do I look like the planting type?
Maybe all the years of analyzing risk, maybe sometimes you venture into something not knowing the risk, and then sometimes it pays off, others not. You wanted to mention something?
Yeah, I just wanted to talk to South African farmers and the resilience that they've shown. Over the last, we've had fantastic years in terms of summer rainfall in the last 3 years, and then El Nino hit us last year, and we lost 30% of our white maize crop and half of our soybeans. Those farmers are still on the land because most of them, and I dare to say, have been financially clever enough to build a balance sheet for this. We knew it was coming, and we talked about technology and our ability to forecast. We had 3 La Nina years, and then El Nino came. We knew it was coming. We knew there was going to be an impact in January, February this year. Did we know it was going to be that severe? Possibly not. I think it was much worse than we thought it was going to be. We know there's a La Nina year coming. We already see it in fertilizer sales and seed sales. Farmers are going to go big this year because they know there's La Nina coming. So hopefully that balance sheet will then restore itself. And I think that's where it's becoming important to assess the pricing of insurance. When we know La Nina is coming, should we charge as much for soil moisture index than we did last year? Possibly not. Andres, I'm looking towards you. So I think from that perspective, there's a lot of, let's call it resilience in terms of the industry as well as the farmers. Would I go and buy a farm right now? I don't think so, because scalability for me, and we see this in the industry, and you talked about corporate entities buying farms. The risk mitigation of those corporate entities is to have citrus establishment in the Lowveld and in the Eastern Cape. Then you are diversifying your risk, and you can come to the bank and you can sell that as some sort of mitigant. Shade netting, for instance, for us is an incredibly important tool to not make sure that only you protect against hail, but according to obviously Nedbank's purpose is money experts who do good. We fund shade netting actively because we know we save 30% water. We know the pack out percentages go up 50%. So for us, that is in terms of SDG 12, responsible consumption and production, critical things we need to think about in terms of agriculture going forward. Sustainability is the only way that we can keep farmers on the land and manage our portfolio in a responsible way. And it's also I would say our duty as commercial banks to conserve our farmers in the way they actually do their business.
So I'm going to give over to you, Saki, now, and then please be ready to ask the panel questions. But yeah, maybe just because I think a lot of the discussion we've had is, and that's the challenge we say, is like the risk is elevated for weather reasons, for political reasons, for others, and then interest rates are fairly high and so there are different ways to mitigate that risk. But I mean, if you're a farmer now in the Western Cape, you're doing wine grapes, I mean, it's not as easy to say, let's quickly buy a farm in the Eastern Cape or the Langkloof and say, I'll duplicate myself, because then it's human capital, you need various other success factors. So how do you manage as a bank? I mean, if you are a typical family farm, you are based in a particular setting, how can you really change that risk profile where you are if you're not planning to move? And then the question is, if you're a wine farm, do I go now into citrus, which has its own risks, or do I go to table grapes, but it cost me 2 million a hectare to go for that? So I think many farmers are asking, everyone talks about diversification, But that in itself is risky. So how do you see that, Saki?
Yeah, so I think agriculture is quite an interesting industry or sector. What I've come to realization is that over time, certain things would change. For instance, we're moving to a La Nina now, and obviously, in terms of yields, there's prospect of good yields. But now, if we look at the front of the commodity prices, I mean, you would know the prediction is that the commodity prices would be coming down. There lies in another challenge now for the same farmer you're talking about who's in a particular area. Diversification might be a challenge, but now needs to see how to optimize and it's about innovation. What I see as a trend that would come in is how does that farmer then move from where he's traditionally positioned and take on the value chain as an option of growing his business, because you would find that if you are in primary production, you sort of lose the margins as it goes up to the consumer, and commodity prices at the shelves are quite high, and the farmer loses that benefit. So what we have seen and our observation is that going forward, some farmers will be venturing within the value chain, and this presents opportunities for the banks, including ourselves, as to how do we position ourselves going into the future and make sure that we've got a capability and our models are suitable enough to look at an optimized balance sheet rather than being focused on a balance sheet that is farm specific. So a level of investment will be required, and these investments would be in a form of, let's say, clubbing up of certain farmers, and this has happened in some of the industries. But now, how do we then finance that cooperative environment, which is taking us traditionally back to where the cooperatives are coming from? But now, with the smaller farmers, we're seeing that coming into play, and we need to gear ourselves in terms of making sure that we've got the correct or the ideal products that would then be able to finance that. And obviously, they don't have strong balance sheets. Then that's where the cash flow lending would come in. You would see what instruments to use in terms of safeguarding ourselves. We have looked from ourselves as to how we can then look at the credit guarantee options to make sure that we safeguard ourselves. Obviously, the risk is there, so we need to make sure that we close the gap. So in essence, there are opportunities in the value chain for the farmers to explore, together with the lenders to be in that space as well. Thank you.
Lo, can I just come in there? And I think what Saki said is critically important. Is if you switch from a balance sheet to an income state basis lending, let's call it product, you start with corporate offtake. And in terms of managing your risk and your margins, that corporate offtaker needs to have security of supply. You then throughout, and we've run this now. We just closed off our 14th season of this program. We call it Virtual Farmer. And the Virtual Farmer program basically, as I said, starts with a corporate offtaker. I have an offtake that is willing to give a minimum price or a guaranteed price for a number of farmers that he trusts in the system. If that farmer does not need to give his balance sheet as collateral, he can use that collateral to go and buy another farm, to go and expand in terms of shade netting or new equipment or new irrigation. So we've seen that model work very effectively because I asked the farmer for no security other than his ability to farm and a small alignment of interest in terms of deposit towards the program. The corporate offtake then secures his margin, and I have insurance wrap over the whole thing that flies a satellite every day. We have monitor satellite remote sensing on those lands every day, and we pick up through a logarithm in terms of a model and a platform that's supplied to us through Mauritius if there is deviances in that. We have people on the ground who goes and checks, saying, you haven't got emergence, we stop financing now, so the insurance covers you up to that point. So that product we found is, and I certainly think it's going to change the dynamic of agriculture going forward, not only in South Africa, but also in the rest of the continent, where I think what we've seen in the continent is to finance thousands of small-scale farmers is just not doable for a commercial bank. You need to find what we found, a hub-and-spoke model. We have a commercial farmer that's willing to then contract with the farmers around him. He would typically have a processing facility, a rice mill, a soybean crushing plant, or whatever the case might be. He wants surety of supplies, and he then contracts with the farmers in that vicinity, and the insurance wrap mitigates the bank risk. So what that farmer does is he actually makes available his mechanization, his technical skills, his input finance and products. So those small-scale farmers gets access to the right type of seed, fertilizer, insecticide, herbicide. And that model for us is something that we really think is scalable on the African continent. We've seen it work, and Kapunga is a rice farm next to the Mbaya River in Tanzania. There's 3,000 small-scale farmers there that now actually supplies to that rice mill. Mpongwe is another project, 13,000 hectares of irrigation in Zambia, where the small-scale holders now supply soybeans into that program. So that model already works in the rest of Africa. I see no reason why we cannot make it work here in South Africa. And I must say, to the credit of our commercial farmers, 99% of them are willing to help. 99% of them are willing to adopt an inclusive model to get our emerging farmers as part of the program.
Yeah, just to add on what Zan is saying, what we've observed is that the value of land is quite expensive. So I think going forward, the issue of traditional lending, securitization based on land, is not something that we should predominantly look at. What is important is the availability in terms of tenure security, making sure that the land will be available for a sustainable time period for that farmer to be able to reap the benefits. We have looked at, in the past, the land bank was used to finance based on productive value of the land. And as such, now, currently, the productive capacity of the land cannot afford to pay the farm. So we've moved from productive value to market value lending. And as such, when we did our calculations, we found that it's anything between 1.5 to 2.5 of the productive value, which is what the current prices are going for, depending obviously on area. Western Cape is a different animal. So you find that for us, it requires us to be creative in terms of saying, how do we then do on lending based on PTOs or leased properties? There's vast land available that is leased. We are venturing there now because we have realized that for a farmer, which is something that, by the way, was done in the past, whereby a farmer would farm on leased land and ultimately buy the land and then start using that farm to pay off the debt of the other farm that they acquire. So now this is the approach that now we're trying to use for the developing farmers, is to say, first have land that you can lease. And fortunately, government has done well in terms of providing available land at a 30-year lease on the back of having off-takes, which mitigates the risk. Our unit also arranges those off-take agreements with prospective markets. So looking at the entire value chain is quite important to make sure that those farmers are successful, whilst we are then not taking hardcore collateral, because then we can be able to take cession of the crop, as Zan has mentioned. So it's quite important that our thinking in terms of enabling the sector for more production and scalability in terms of using the land that is lying fallow is to have that creative thinking in terms of how do we then securitize it without using hardcore collateral.
Andries, I'm going to have you, and then we'll open up for questions.
Yeah, I think a very important point that came out from both Zan and Saki is the amount of innovation. So if we continue doing things like we've done it, and I mean, this is old news for everybody, we're just going to keep on battling to get financing, to get insurance, etc., etc. But the amount of creative energy that the industry, the banking industry, as well as the insurance industry has been putting into that is great. But what is also heartening is there's a younger generation of farmers coming in who are prepared to adapt based on the logic behind whatever is suggested, as opposed to historically being bound by, I don't know, a bank with a plow or whatever the case might be. But the fact of the matter is, guys, we've got to change, because if we don't change our farming practices, our interaction with nature in general, our banking, our insurance, if we don't change it, then we're heading for a collision. So it's actually a very simple calculation to make. You've got to change. You've got to create a new way of doing things. And we're all online, and we're really there with. But if you, Mr. Farmer, don't come and ask the questions, I'm not going to give you the answers. And I think that's the quest.
Great. On high notes, questions. You can have one at the back. We'll take 2 or 3. I'm sure there must be more too. Is there a third one? Okay, let's take those 2. And if you're scared, if you're thinking you must or mustn't ask, then the answer is you must ask. So let's take that first one.
Hi there, I'm Alani from Landbou Weekblad. I just want to ask you, in terms of optimal planting times, especially in the summer region, we're talking about climate change and how things are changing. I know some of the farmers have spoken to the insurance companies and the banks before. Is there going to be a change in terms of those dates as things seem to be changing in terms of climate? Have they seen that specifically also for climate? And then in terms of conservation agriculture, is the financing and the insurance also looking at what farmers are doing in terms of conservation agriculture to give them an offset in terms of whatever financing they need?
Good morning, everyone. My name is Vukani. Firstly, to you, Lord, I just want to confirm that the Blended Finance Program has been running. The CEO of Land Bank spoke last week, Friday, that to date, it's 200 farmers who've been financed to the tune of 2 billion. So I do want to confirm that that is running. I just want to ask a broad question to the panel as a whole. I think for me, the theme that has emerged from this talk is that doing things differently is important, because we can't expect yesterday's solutions to answer tomorrow's questions, right? So the question for me then becomes, is there, in as much as there isn't a silver bullet to solve all the issues, but if there's one thing that we could do right as financiers, as insurers, what would it be? I've heard coming out the index insurance, which seems to be some level of solution. You spoke a little bit about what is happening in Kenya as well. In as far as the subsidization that's going on and the model that's going on there. For me, I just want to find out for the South African farmer, if as financiers and as insurance we did one thing right, what would it be? Thank you.
That's just 2 great questions. I'll definitely hand it over to the panel. So I don't know who wants to take which one, but Andries, let's maybe start with you. You can tackle either one. If you take the easiest one first, then you'll give the difficult ones to them. So
I'm so severely tempted, but I don't know which one would be the easier or the more difficult one. I think perhaps the silver bullet, which is not a silver bullet, is in a perfect world, both the farming community, the financial services and support industries within agriculture, and government will get over their egos and understand that as a collective, we can change the world. And we can be so much greater than the sum of our parts. But everybody needs to play, and play nicely. I think that's Is it attainable? I think in the real world it can be attainable. Is it currently being attained? In places.
Maybe just on the question in terms of the planting times and actually let's call it the window. Um, in terms of the program I've been talking about earlier, what we call virtual farmers, we are being guided by our soil moisture index probes, and they would guide when the farmer can plant. So the model works on a prepayment system where the farmer actually sells his crop before he put a seed in the ground. He gets a partial payment to pay for his production inputs, so seed and fertilizer and diesel, and he would then be guided by the soil moisture index correspondence that he gets on his cell phone. And I think that's another thing in terms of the silver bullet is technology, especially in Africa where everybody's got a smartphone, sharing of information. I've got this hoho on my cotton plant. Take a picture and send it to your buyer. What is this? What must I do? That is prevalent all over East Africa at the moment. But just to come back to the planting window, so the soil moisture index, the correspondence on his cell phone will tell him you can plant now. It tells you that your window is right. Obviously, depending on cultivars and what the crop is that you're planting and all those type of things. But if you plant outside of that window and you do not get germination and we can't see crop emergence at that point, the policy responds. And it's as easy as that. It's not about the balance sheet. It's about you planted at the right time. The policy will respond if there's no emergence. So I think that's important. Also important, it's never a zero-sum game, right? So there's always a yield. And I think from that perspective, banks have got the responsibility to pay out on a certain percentage of long-term average yield and not fund the farmer for profit upfront. That's not what we do. The farmer has got a responsibility to produce the crop, sell it to the corporate off-taker, as I explained earlier, and only then he gets rewarded for what he does. And so often, banks give production loans to a farmer in terms of a loan-to-value ratio on his land that actually compensates him for loss. And then the farmer is very much sitting back, relaxed, and say, I'm comfortable, I've got the credit I need. The farmer needs to actually communicate back to the lender in terms of the progress of the crop. If he doesn't, we've got the remote sensing technology. So I think technology is crucial. And we see that where we have clients in East Africa that is now is reaching out. One of our clients is reaching out to 8 million farmers in Tanzania and Kenya via cell phone technology. And they buy sesame seeds, cashew nuts. There's a whole lot of things, yellow gram, green gram, pulses. All these type of things are markets that they trade in, export to India, and they need to understand what the yield is, what the price is, and they communicate with the farmers via cell phone. So there's a lot of technology that is already there. M-Pesa in Kenya in terms of a payment mechanism, fantastic technology, working extremely well. There's no reason why we can't have that type of technology here that enables virtual payments for farmers, showing a picture of his crop saying, my yield is going to be this, and the assessment is there and he gets a partial payment. So there are a lot of things that's already happening in Africa that I think is really scalable in terms of the industry.
Yes, I think if you look at the planting window, I think those dates are no longer relevant. They are a guide these days. So I think what is important is better planning. Fortunately, with technology, the meteorologists are able to predict and provide those insights in terms of what to expect. So it's an issue of planning, and hence the collaboration that Andres was talking about. Because if you look at from the seed perspective in terms of research, the window period, the shorter it is, it means there needs to be an improvement in the seed variety. So seed is quite important, the type that we would use for that particular window that you have. So those are the planning mechanisms that the farmer needs to put in place. And also moving from the farmers, you go to the banks. The banks need to make the facilities available in time, in line with the changes in the planting window periods. This means then that the traditional way of looking at the assessments need to be looked at going to the future, whereby the technology is applied in terms of building data of your client and understanding certain areas so that you are then able to make informed decisions based on the data, because the tendency is to wait for the financial statements. You wait for all the pile of information that we normally ask for. And I think going forward, if we are to respond to to changes in climate as well as challenges in the sector, we're going to be faced with challenge. So it's quite important for us to be proactive as the role players, including insurance as well, as role players in the sector, and see how do we best adjust our processes and methods with the use of technology to make sure that we meet the needs of our customers. I think that is quite key. And then on the issue of the impact in terms of the sustainable practices that the farmer would deploy, making the funding affordable. I think there lies in an opportunity. There's green bonds, there's other facilities that are available which need to be tapped into so that if a farmer is demonstrating deploying sustainable practices, regenerative agricultural practices, smart agriculture, water efficient usage, then if there's a benefit from a pricing perspective that can be given, you will get more of those farmers coming into that space and have a better environment for the future of the next generations to come.
Andrew's last word.
There's a lovely practice in business where people say, rather than ask permission, apologize afterwards. I think we have to say that when you're dealing with your bank, with your insurer, don't follow that practice. Do this beforehand. If you're going to change planting windows, make sure that your insurer is on board prior to doing it and not when the proverbial hits the fan. So, guys, we're still talking about money. And as businesses, that remains our primary responsibility also to our shareholding. It's a business we run, and it's a contract essentially that you go into or enter into with your insurer or your bank. Play according to the rules. And I think you'll be amazed at how much you can achieve. But have the discussion. Don't apologize afterwards.
Play by the rules. Ladies and gentlemen, you've heard from the insurer, the ag economist, and a chartered accountant. And I think we've had a great discussion. Thanks for joining this discussion this morning with Agri in Conversation on Agri Finance. Just for everyone here, there's a different show also taking place at the moment. So if you leave out the door quietly, please. If you want to stay around, I'm sure these gentlemen will be around to take more questions if you want to engage. But thanks a lot for joining and enjoy the rest of your day. Thanks.